Welcome everyone to the fifth session of financial statement analysis, where we'll now cover the assets part of the balance sheet. In the previous session, we did the liabilities. Just to sort of summarize what we did the last time, uh, I'll just cover the basics again. So, as you know, in a balance sheet, we have two sections. One is the total asset section, and other is the total liabilities section, which can be broken down into two items. One is the shareholders' equity, and then the other liabilities. And this will include current and non-current liabilities. Any liability which has a life of more than 365 days becomes non-current liability, and any liability which has less than 365 days is basically current liability. That's how we differentiate between current and non-current, right? Now, just to recap the liability section before we get into the asset section again, we have what we call the equities part. Equities is basically equity share capital and other equity. Equity share capital is nothing but number of shares multiplied by the face value of each share. And then other equity comprises of general reserves, capital reserves, securities premium, and retained earnings. These are the biggest items which are part of the other equity. Within the non-current liabilities, these are basically long-term liabilities that the company has to fulfill. So the company is liable to pay, but the payment is due after 365 days, that sort of thing. So for example, long-term borrowings, let's say you take a 4-year, 5-year loan, that will be part of non-current liabilities. Long-term provisions, for example, you have to pay gratuity to your employees. That is something which will come after a year. So these are long-term provisions. Lease liability is something that we've leased for a period of more than 365 days. All that is required to be put on the balance sheet as part of the Ind AS accounting process. Then we have tax deferred liabilities, which is basically difference of taxation, which is caused because of Companies Act versus the Income Tax Act. And then we have deferred revenue, where we book our revenues first. So we get the revenue first. So we receive the cash flow, but then we have not yet serviced the customer. So whatever is the pending amount has to be shown in the form of a liability on the balance sheet, right? A detailed, description of each of these line items has been covered in the previous session. So please do revisit that. In the current liabilities, again, most of the items that you will see are basically the same. So here we had long-term, we will have short-term. Short-term is anything that is payable within 365 days. Short-term provisions, again, gratuity payments, statutory payments that are to be done within a period of 1 year, 365 days. Trade payables is money that we owe to our vendors, which basically, they gave us some raw material on credit, and then now we have to pay back on 30, 40, 65, whatever is the payment criteria. Now, as you would understand, the lower the trade payable, the better it is, because, sorry, the higher the trade payable, the better it is, because then I'm able to pay to my vendors after taking more amount of time. So, if I'm able to pay it after 90 days, even better. If I'm able to pay after 120 days, even better, because that gives me the flexibility to manage my cash flows. Next is short-term lease liabilities, right? So any liability that I have to any lease payment that I have to pay within a period of 365 days, that will be short-term lease liability. And other current liabilities, this includes, advances received from customers, right? That sort of thing. Plus some statutory liabilities are also part of your, or taxation and all that is again part of other current liabilities, right? So that's the quick recap. uh, you know, uh, this has to, at the end of the day, both all these put together, A, B, and C, match the asset section, the total asset section, which we will discuss today, right? So let's get into that. Today we'll cover the asset section of the balance sheet. Now, asset section is basically what do you mean by assets, right? So assets is anything that the company owns, right? These are assets which are held by the company and which are required for generating the revenues or conducting the business, right? These can be both operational assets as well as financial assets, right? So just to break it down, you can have operational assets, right? And you can also have financial assets. So when we go through each of them, you will understand which one is operational, which one is financial. But something like a building, machines, all of these are operational assets. Uh, something like money, cash, investments, these are financial assets, right? So broadly, that's the difference. Then you can break up the assets also in the form of current and non-current, which is what accounting standards tell us. They tell us that you need to basically break up your assets and liabilities uh, in terms of what is current and what is non-current, right? So again, here anything that we that is liable to us, that is ours, which has a life of less than 365 days is current. Anything which has more than 365 days is non-current, right? So that's broadly the structure of the assets. These are all items that we own or have control over, or somebody owes that monies to us, right? And think of it like this. So the liabilities part of the balance sheet is where you get your money, and the assets part of the balance sheet is where you put that money. Now you can put that money in machines, buildings, investments. You can put that money in bank. You can deploy that money in mutual funds. So whatever is required for you to run that business is where you will deploy those assets, right? So that's essentially the basics of this. Now let's get deeper into non-current assets first, and then we'll get into the current assets. Abhi, these are assets, the economic benefit of which is enjoyed over a longer period of time, basically more than 365 days, right? So, so for example, you can see the line items here. There is property, plant, and equipment, which is nothing but your buildings, right? Your land, your machinery, right? Whatever that you need to run this business. Then there is something called as capital work in progress, which is again the same thing, but this is still under development, right? So any building that is under development will be categorized here. Anything that is yet not operational will be part of CWIP, capital work in progress. Next time you see this term, don't get frightened by this. The third is intangible assets. So for example, property, plant, equipment, this is a tangible asset because you can touch, feel, uh, and these are intangible assets. You can't touch and feel these assets. Uh, Something like patents, some software that you bought uh, for let's say 4 years, 5 years subscription you've taken, all that is intangible asset. Then you have financial assets. So financial assets can be that you deployed your money in some company. So let's say you are a company A and you bought some stake in other company B. So either this can be equity, uh, or this can be debt, or this can be other financial assets. Then you have income tax assets, which is basically uh, you know year one you made a higher tax payment. So now that you made a higher tax payment, this can be used in the next year to reduce your tax payment, and so that becomes an asset for you because this means that next year you will have to pay less. So these are deferred tax assets in most cases called DTA. Now we've seen property, plant, equipment. There is something called as right of use assets also, and this basically ROU. We'll discuss this in detail, but this basically comes because of lease. So let's say you leased an asset and hence you have the right to use it. So because you have the right to use it, You can call it an asset of your own, and the right is basically valued. You're not really bringing the asset here itself, but the value of the right to use, that is what you're bringing on the balance sheet here. So it's almost treated like an intangible asset. It's not a tangible asset actually in terms of accounting treatment. Capital work in progress we did see. Other intangible assets we'll discuss. And intangible assets under development is again CWIP, but for intangible assets. Capital work in progress, same terminology, but for tangible assets. Then financial assets can be two forms: investments and other financial assets. We'll look detail into each of these line items. And then we have other non-current assets, which can be advances paid to customers, employees, clients, whatever. So that's basically the run-up of the line items. We'll discuss each of these now in detail, right? So, so non-current assets, we'll get into each of these line items now. We're looking at fixed assets to begin with. So fixed assets are assets which cannot be converted into cash easily, or which cannot be liquidated easily. That is how you define fixed assets. So fixed assets will be your stuff like plant and machinery, your vehicles, your buildings, your fixtures, anything on the balance sheet that cannot be liquidated easily. These are tangible assets as well as intangible assets. Now, intangible assets can be in the form of patents, you have copyrights, you have trademarks, you have designs. These are your intangible assets because you can't touch and feel these assets, but then they are assets, of course, right? So if you look at the breakup of the property, plant, equipment, which is note number 3.1, now do follow these note numbers because that's where you get the detailed breakup of those line items, right? So if you want to look up on any asset, just go to the relevant note number and it will give you a breakup of those assets. So here you get a very detailed breakup of, for example, land. How much land, for example, is being held by the company and what is the value of this land. So this value is, for example, the freehold land value is 1.24 CR. Now, mind you, this is the land value which was at the time of buying. Okay. It is not the current land value of the land, right? So this is very important to note. This is what the company invested in that piece of land whenever it bought that. It might have bought the land 10 years, 20 years, 50 years ago, right? So this is the value of the land when they bought the land. So for example, it was 1.24 CR when they bought the land. This my land might actually be more than 20 CR today. I'm just taking an example. But so that's where there's a difference between the book value of the asset and the market value of the asset. So on the books of the company, the land is shown at the book value, which is the value at which we bought. But the market value of that land as of today might be very different, right? So this is an important distinction to understand. Then we have leasehold improvements. Leasehold improvements is anything that you spend on top of the land to improve it, right? Or you took something on lease, for example, and let's say you did some improvements to it. So for example, you took up a building, but then it was just a shell, as in it was a constructed, fully functional building, but interiors was not done, for example, let's just say. So you invested in interiors. Now, whatever money that you invest in interiors is also going to come on your balance sheet, and that is called as leasehold improvement because that money was invested in the lease that you took in improving that lease. Then the buildings that you yourself own, the plant and equipment that you yourself own, the furnitures and fixtures that you yourself own, vehicles that you own on your balance sheet. Look for interesting stuff like how many BMWs and Mercedes are figured here, right? I mean, sometimes you go to these vehicles and you see what is the average value of the vehicles that are there. So, most promoters, what they do is they will buy a 50 lakh car in the name of the company, and they will show it as an asset of the company here, but this car will be solely for the use of the promoter himself, right? Stuff like that. I mean, I'm not saying this is something wrong, but then this amount is very important. The size of this amount is very important in that situation. Then we have office equipment. So whatever, equipment that you buy, which has a life of more than 365 days. Now, which is where I said that consumables, for example, pen, pencil, all that stationery stuff, that is purely expense. It is never brought on the balance sheet because it doesn't have a life of more than 365 days. Computers, for example, whatever, employees buy computers on the balance sheet, that will come here. And then you have a line item which is capital work in progress. So what else is currently in the development? So for example, let's say they are building a new warehouse and it has still not become operational. So whatever building fixtures and furnitures, plant equipment that is getting invested in this warehouse or being bought, that will show up here, right? And this is a very important line item, especially from an investing point of view, because this tells me how much capex is happening. So what sort of new capacity is coming in the company? Where are they investing? How much they are investing? And how much revenue generation will this new capacity lead to, right? So that sort of understanding you get when you look at this line item, capital work in progress. I'll just take 2 minutes to for example show you the importance of this. So let's go to screener and let's look at, for example, a company called Aarti Industries. So because ultimately we are all coming back to the screener to look at these numbers, so I thought I'll just show this to you in the screener also. So look at the asset side. So this is the asset side here: fixed assets, CWIP, investments, other assets, right? So this is the asset part of the balance sheet, and this is the liability part of the balance sheet, right? Now, as you can see here, the CWIP number is a big number: 436, 795, 1418, 1298, 1490, 1392. So almost 1400 crores of capex happening here, which means new incremental investment that the company is doing. And what will happen is, once this seed capex or the new plant becomes operational, it becomes part of the fixed assets. It is no longer called CWIP. So for example, it takes, let's say, 2 years for this capacity to come up and become operational. After 2 years, it will become part of fixed assets. So which is why your fixed assets have been continuously increasing, because more and more of the CWIP is coming and becoming part of the fixed assets. So because once it is operational, then you can call it a fixed asset. And that number has kept on increasing. Let's say 2015, it was only 1,000 crores. Today, the fixed assets is 4,000 crores. That just shows that how much the company has been reinvesting in growing its business, right? And similarly, you can get an idea of what sort of capacity expansion is happening in the company. Now, the same thing can be looked at from other intangible assets point of view. Just let me go back. Yeah. So other intangible assets, we have softwares, technical know-how. These things also have some sort of value. So for example, this is valued at around 79.53 crores. And there is more of it coming in intangible assets under development. This is 0.33 crores. As we discussed last time also, for example, for a software company, this number has to be relatively higher. So do check out companies like Nazara, again, software gaming company, or IndiaMart, or companies like Intellect Design. These are software companies. They keep adding more and more new features, and that is an intangible asset for the company. So for software companies, this number will be slightly higher. This we are looking at company called Amar Raja. Now they are mostly a manufacturing house, so they are very heavy on the tangible side of the assets, not so much on the intangible side. But depending upon the business, you could have the intangible assets also much larger than the tangible assets. Uh, for example, right? So that is fixed assets. Like I just to summarize, fixed assets can be uh, tangible, intangible, all sorts of uh, expenses that the company makes, which has a life of more than 365 days, can be called as uh, you know assets of the company, both tangible and tangible. Anything that has a life of less than 365 days, we just expense it, right? We don't care to put it on the balance sheet. We'll just put it as a P&L expense, and we are done with it. Because what happens, as you would know, these assets. So let's say we did discuss the depreciation line item, right? And there also we discussed intangible and tangible assets, because so let's say you invest in a building, and that building has a life of, let's say, 30 years. So you can depreciate the value of this building in your P&L over 30 years. You can do a straight line depreciation, you can do a accelerated depreciation, whatever. That's a discussion for some other session, and mostly for the accountants to figure out. Uh, but uh, but basically, that's how depreciation comes. It comes because you have assets on the balance sheet. If you don't have assets on the balance sheet, then there will be no depreciation. As simple as that. So that's the fixed assets bit. Let us get into how this whole depreciation piece works out. Right. So I have this is again note 3.2, 3.1, same note, property, plant and equipment. This also includes capital work in progress. Now, what they have done basically in this note, they have taken each of these assets, right? So leasehold improvement, building, plant and equipment, furniture, vehicle, office equipment, computers, and the total, right? And now so this section is called which is cost or deemed cost. This is also called your gross block. Okay. This section is called your, as you can see, accumulated depreciation. And the last section, which is the carrying amount, is called the net block. The maths is simple and very logical, so just hear me out. So the formula goes like this. The net block is gross block minus accumulated depreciation. Now, the logic is very simple. Let's say you bought a machine which has a life of 5 years, and you bought it for 100 crores, and you are doing straight line depreciation. So what you will do on on year 1, year 2, year 3, year 4, year 5, right? These are the 5 years where you can use this asset. After this asset can be disposed at, let's say, zero value. This has no value for us. In my first year of operation, on the balance sheet, I will show, and so let's say this is end of year 1. We are talking end of year 1, end of year 2. So at the end of year 5, it will be 0. So end of year 1, and let me also show year 0. So at the start of and end of year 0, the balance sheet shows a value of 100 CR, right? Basically, at the start of year 1, on let's say 1st April 2021, I bought this asset. The value of the asset is 100 CR. Now, after I've used the asset for this whole year, the value of it, so my depreciation value is what? My depreciation is basically 100 divided by 5, which is 20 CR. So every year I have to depreciate 20 CR. So my depreciation is 20 CR in the P&L. and my accumulated depreciation. So these are the three items I'm calculating. The carrying amount on the balance sheet, the depreciation, and the accumulated depreciation. So the gross in year one, the gross block at the end of year is, the gross block is always the value that you paid for it. So the gross block will always be 100 CR. And your, after in first year, you depreciate 20. So your carrying amount is 80. So this is your net block. This is your year one, right? So I will show at the end of year one, my carrying amount is 80, depreciation in the P&L is 20, accumulated depreciation is 20. Next year, my balance sheet carrying amount comes down to 60. My depreciation is 20, accumulated depreciation is 20 plus 20, 40, right? Carrying amount then reduces to 40, 20. At the end of year, it becomes 0. Depreciation each year is 20, and accumulated depreciation goes to become 60, 80, and 100. So at the end of fifth year, you have completely depreciated the asset. So your accumulated depreciation becomes 100. Your carrying amount on the balance sheet is 0, and your annual depreciation is 20, and this is part of the P&L. That's essentially how this is accounted for. So this is the formula here. And what you're seeing here is basically, so let me just show you one simple example here. So vehicles, for example, had a value of 16 crores. We added new vehicles 4.44 crores in the year. We discarded vehicles of 70 lakhs value. So 70 lakhs value vehicles we disposed of. So the net gross left was 19.89, right? This was from 2020 to 2021. Then 2021 to 2022, 11.5 crores of vehicles added, 4.06 crores of vehicles disposed. My net block is, my gross block is 27.33. Now this is the value of the vehicles we bought. Then we come to accumulated depreciation, which is nothing but starting amount plus the addition minus the disposal. Then we come to the end of the year amount. So if you look at how it is, 2021, the starting amount is, this is your net block, right? So 12.06 crores, and that has gone to 19.35 crores. That's the net block at the start of the year and the end of the year. That's as simple as that. What you basically do is you subtract 19.89 and 7.83. So 19.89 minus 7.83 will give you 12.06. And 27.33 minus 7.98 will give you 19.35. Basically simple, gross block minus accumulated depreciation will give you a net block. These are accumulated numbers, this is gross numbers, so you get the net numbers, right? And very simple example I've given you. This is how you depreciate in the P&L. This is how you show the gross number and the accumulated depreciation number on the balance sheet. Now, one thing I want to point out, and you can look up any balance sheet for that matter. Any balance sheet will tell you what is the life that they are using to calculate the depreciation. This you will find in any annual report. Go to the depreciation section. You will see that the building is depreciated over a period of 60 years. Plant and machinery depreciated over a period of 10 years. Solar equipment over a 25-year period. Furnitures and fixtures, depending upon what furniture, what fixture, 5 to 10 years. Again, so this is the range, 3 to 60, 1 to 10. Vehicles anywhere from 3 to 10 years. Office equipment anywhere from 3 to 5 years. Computers anywhere from 3 to 6 years. So that's they also mention you the life of the equipment. This you can find it in the annual report. Right, so that tells you that the asset has been depreciated over what period of life. Okay. So that was fixed assets and depreciation related to fixed assets and amortization related to intangible assets. Right. Now we talk about another line item, which is called the right of use assets. And I'll give you some examples of what it means. Basically, when we were discussing the liability section, we had something called as a lease liability, if you remember. What it meant was that, let's say you have taken something on a long-term lease, let's say 5-year, 10-year lease. You've taken a building or a vehicle on lease, so it's not yours, but then you have the right to use that asset. That right has some value, and that value has to be brought on the balance sheet. So if you remember lease liability, we said the present value of all the payments that we are going to do is your lease liability. So that's the liability section. So but what comes on the asset side? So on the liability section, you have lease liability coming, and on the asset side, you have something called as the right of use, uh, no, which is nothing but, the formula is very simple. It is initial amount of the lease liability. Remember, it's the initial amount of the lease liability plus lease payment done before the lease commencement, plus any indirect costs incurred to get into the lease, minus any lease incentives received. Now, it might sound slightly heavy. Uh, so, but very simply, it means, whatever is your lease liability, initial lease liability on your first day of the starting year when you're getting into the lease, whatever is the present value of all the lease liabilities plus the lease payment minus the incentives. Okay, that becomes a right of use that comes on the balance sheet. Now, the reason why it is called an intangible asset, because it is a right. You're not really bringing those assets on your balance sheet. You're only valuing the right to use that asset, right? By looking at the cash flows and discounting those cash flows, right? So these right of use assets, these must also be amortized. So for example, you get into an agreement to buy an asset, to lease an asset for 5 years. So the value of the right of use has to be depreciated over a period of 5 years in the P&L, right? And hence you will have accordingly have stuff like, similarly, like you had it in fixed assets, you will have the gross block of the right of use, then you have the accumulated depreciation, and you have the net block. So that's how right of use is. Uh, the calculation of ROU and the lease liability is slightly more complicated. What I will do is I will post an example with you, so you can see through the calculation of the right of use and the liability and the lease liability, if that is of interest. Um, as investors, what we need to understand, we can treat this almost like a fixed asset, right? For us, the line items are the same. So we have leasehold land, buildings, property, plant equipment, office equipment, computers, same uh, uh, items mostly. Uh, Basically, we have taken these items on lease, and this is the right of using those assets. Um, Calculation of it is slightly more accounting led. I'll just post an example in the group for you to go through the example. But mota iska funda is similar to what you have on the fixed asset side. Like I said, uh, this lease liability is what will come on the liability section, and the ROU is what will come on the asset section. Now, this is depreciated in the P&L, and this is shown as interest expense on the P&L. That's the P&L treatment of these two items. Let me just get into that. So as you can see, the ROU, right of use assets, must record the amortization of the ROU asset to the income statement, right? So whatever is the number here, it will get, whatever is the number here, this number will get depreciated and show up on the P&L in the form of depreciation expense and on the P&L side, right? Whereas the lease liability will show up on the income statement as interest expense. So that's the difference. The ROU will come in as depreciation, and the lease liability will come in as interest expense. This is almost, if you look at the analogy, this almost feels like you've taken a loan to buy an asset. So the lease liability is treated like a loan, and hence you have interest expenses relating to that loan. And you use that loan to buy the right of use of those assets, and those assets have to be depreciated over the lifetime of the lease in the form of depreciation. Okay? So what we are saying here is the ROU will have an impact on the P&L in the form of depreciation, and the lease liability, which is figuring in the balance sheet, will have an impact on the P&L in the form of interest expense. I will post an example of how this is calculated in terms of numbers in the form of a PDF in the group, and you can go through it to understand this better. But mota treat it like fixed assets. If you go to for example, if you go to screener, all you will see is fixed assets. Now if they break the fixed assets, they will show you uh, they won't show you fixed assets and right of use assets separately. All they will show you is that they will club the land, building, plant and machinery together, right? So fixed assets plus right of use assets, land will be clubbed together, because and then depreciation for the fixed assets and depreciation for the right of use assets will be clubbed together. That's how the final number will be arrived. So here you won't be able to get the breakup, and to be honest, it's not required also, right? uh, I wouldn't worry too much about the ROU thing. It's just that uh, what happens on the liabilities, like we discussed. On the borrowing side, this will show up as lease liabilities will have a separate number. Now, you need to understand that it's not really a debt that you have taken, right? It's an accounting number because you've leased something. It doesn't mean that you have borrowings. But in the P&L, in the balance sheet, for example, it will come within the borrowing section, show up as lease liabilities. So just be careful whenever you calculate debt to equity, exclude this portion. This is not really debt that you've taken, right? That is very important to note. Now let us get back to the next section where we talk about the capital work in progress and intangible assets under development, right? So as part of the same note, remember note 3.1, because this also includes capital work in progress. We have projects which are in progress, investments done in less than a year, 1 to 2 years, 2 to 3 years, more than 3 years, right? Anything will be called capital work in progress before it becomes part of fixed assets. The moment it becomes operational, that asset will become fixed assets. It will move out of the CWIP bucket and it will get into the fixed assets bucket, because now it is operational. It has started generating revenues, right? That's how you differentiate between a CWIP and a fixed asset. Okay, so here you will also find the aging. Some assets have been in development for more than 3 years now. Some assets, so this is the value of the CWIP from 0 to 1, 1 to 2, 2 to 3, 3. So you know what asset. So majority of the investment is happening between 0 to 1 year, right? Very few investments which have been happening for more than 3 years, but still not converted into fixed assets, right? So that way you get to know how much money invested and how quickly will it become operational. It's the same thing for intangible assets also. As we discussed, this amount will be much higher if you are looking at a software business. So that's your fixed assets and CWIP, or intangible assets under development, right? We've discussed all of these are either operational assets or assets under construction or work in progress, right? So whatever we've discussed till now, you would relate these are all operational assets. These are real machines, buildings that we need to run the business, right? So these are core operational assets of the business. The other thing that you need to note is that whatever number that is mentioned on the balance sheet, which is the gross block that is mentioned on the balance sheet, is the amount that is invested. It's not the market amount. So let's say if I bought a vehicle and I put in 5 lakhs. So on the balance sheet, the gross block will show as 5 lakhs. Although it is said that, a car, once it moves out of the showroom, then and there it goes through a 10 to 30% depreciation. So the market value of this asset might actually be 4 lakhs, but on the books it is showing as 5 lakhs, right? So that, note the difference between the book value of something and the market value of something. This is very important to realize when you read up, Buffett and Graham. Uh, these numbers become very important because sometimes what they do is they use the asset approach of valuing a company. So, for example, if I have to liquidate a company, right? If I, let's say, want to sell this company and I'm just calculating what are the assets on the balance sheet and what is the value of these assets on the balance sheet. Now, whatever number you have written on the balance sheet is the book value. It's not the selling value. If you go and sell out these assets in the market today, you will not realize the book value numbers. You will only realize the market value numbers. So to have that understanding of what is the actual real value of the assets, the book value is of very little help. All I want to point out is book value is not the real estimate of the true value of those assets. Let's say you have an asset on, for example, land on the balance sheet, and the value is only whatever 20 lakhs. But you bought this asset like 20 years ago, and today this land is more than 5 CR. So if you go out and sell this asset in the market today, you will get 5 CR. This 20 lakhs is not relevant anymore. That's all my point is. Any questions here before we move to financial assets? We've covered all the operational assets till date.
Ujjwal, I understood that, book value and all, but in terms of a realization, what exactly it looks always the true value, right? It's the market value, right?
Market value is the value at which you will be able to sell those assets.
Okay.
Right? That is what you will make when you sell. So yeah, I mean, try and that's where your industry experience comes. For example, there is a valuer, for example, if you appoint a chartered accountant to do a valuation of your business, he will look at the real value of these assets. That's where his expertise will come in. That's why you hire a valuation expert to tell you what the real value of your business is. I mean, he will there are many ways of valuing an asset. One approach is the asset. You look at the balance sheet and you say that, these are the value of the assets, these are the value of the liabilities, and hence this is the net worth of the company. That is one way to value the company. Typically, companies that have very high on the assets. So manufacturing businesses, they are very high on assets. So there, this is really relevant. IT companies, for example, it's not so much relevant. There you are looking at earnings. So the asset approach to valuing will not be applicable for an IT company, whereas the asset approach to valuation might be, valuable for a company which is into the business of buying and selling lands, for example, or very capex heavy or manufacturing heavy businesses. So that's where the valuation expert will come into the picture. Sorry. So now let's get into the investment section. So now we are getting into the financial assets, and this is a very interesting section because what happens, there are all types of assets, all types of financial assets that a company might be investing into, and there are different accounting principles also as to how the value can be realized in the balance sheet as well as the P&L. And sometimes these things can get very technical. So let's as an investor, because we don't want to get into the chartered accountant shoes, we want to look at the balance sheet and think like an investor, right? So these financial assets also, can be, sorry, these financial assets also can be broken down into two parts, current and non-current. So as you see here, this is non-current. What is non-current? Let me first quickly, get to this slide. Here we will cover some of the basics. So assets, whenever you buy a financial asset, accounting says that you have to categorize into three buckets. One bucket is called held to maturity, one bucket is called available for sale, and the third bucket is the trading bucket, right? And I will explain. So these assets have no reliable market value, but you intend to hold to maturity. So let's say you bought a financial asset where you invested in a company. So let's say InfoEdge, for example, very famous example, invested in Zomato. Okay. And this is pre-listing. This is not when Zomato got listed. This is at least 6 years before Zomato got listed, when there was no way to determine a market value for those shares. Mind this. So we are talking Series A, Series B. So let's say InfoEdge invested in Zomato in the Series B round. Just taking an example, they bought some shares of Zomato. This was a financial investment. So it becomes a financial asset for InfoEdge as a listed business. It will come on the financial asset section, but then there is no reliable market value. So we don't know if the Zomato share is whatever, 100 rupees a share, 200 rupees a share, because it's not trading in the market. Only when you go and do a deal, so let's say Series B ke baad there is a Series C, then that's when you know, okay, in Series C, Zomato got valued at, let's say, $2 billion valuation, whatever. So there is no reliable market value, first of all, and you don't intend to sell these shares. So you don't intend to sell the shares of Zomato for a very long period of time. In fact, I think they've not sold those shares for more than 7-8 years now. So these assets are classified as held to maturity. What you essentially do is you record these assets on your balance sheet at cost. On the balance sheet, it will come at the cost. What is meant by cost? Whatever money that you put in is your cost. If let's say you, even if the value has doubled, even if it has become 2x, you will still book it on the balance sheet as cost. For example, land you bought, land is not a financial asset, it's a tangible asset. But let's say you bought land with no intention to sell, so it is held for maturity and it will show up as cost. That's what it happens. Land shows up only as cost. There is no way that we keep changing the value of land in our balance sheet every year. We don't do that. It comes as a cost, whatever cost that we invested in. So this is one kind of asset. So mostly unquoted investments that happen in the private markets, that mostly comes into this bucket, which is held to maturity, and these investments are showed as valued at the cost at which you bought. Next, then there are second bucket of assets called available for sale. So this is slightly more technical, but let me just go through this so that these terms are not completely new to you. At the end of the day, you might skip, to get into this much detail, but you still should know what these terms are, right? So these assets are held for sale, which means I know for sure that I'm going to sell these assets. I have already earmarked them for selling. So any unrealized and these, there is a reliable market value to value these shares. There is no intention to hold to maturity or trade for profit, right? So I don't intend to hold this till maturity, but I don't intend to trade also for profit, right? So so these assets are valued. The fair value is the accounting method that is used here is called fair value through other comprehensive income, OCI. OCI is other comprehensive income. What happens is that any unrealized gains or losses reported through other comprehensive income. Now, I'll show you what is other comprehensive income, right? Then we have a third category of assets which are specially earmarked for trading. So this is purely for trading purposes we invested and we intend to sell. So there is a reliable market value available for these assets and we intend to profit over the near term. So the way you classify this assets is purely on the intention. Now, this is the most important word here, intention. कि आपका इंटेंशन क्या है इन्वेस्टमेंट का. आप हेल्ड टू मैच्योरिटी रखने वाले हो, आप कभी बेचने नहीं वाले. योर आइडिया इज टू होल्ड इट टिल मैच्योरिटी. देन उसका अकाउंटिंग अलग होगा, राइट? इट इज ट्रीटेड डिफरेंटली. if your intention is that this is available for sale, classify this as available for sale, then the accounting treatment will be different. If this investment is classified as trading investment, then uska accounting will be different. Okay. In both of these cases, there is a market value available. So let's say you invested in bonds, right? Now bonds have a market value. Daily basis, you will know what the value of the bond is. Or let's say you invested in mutual funds. At the end of the day, you will know what the market value of those mutual funds is. There is no market value, right? And you intend to hold it for maturity. So depending upon that, your financial assets can be different types. You could be investing in startups with the intention to hold to maturity, so that accounting will be different. You would be investing in bonds with the intention to sell, not just today, but at some point of time, it is available for selling. And then you could be investing in trading where I have to sell within a year. So the profit booking or loss booking, whatever it is, has to happen within a year, right? Something like mutual funds. So the accounting for all of these three types of financial items is different depending upon the intention. Now, let me give you an example. So let's say we are evaluating a bond. We invested in a bond at $100. So let's say we invested in this bond which was valued at $100. After 6 months, we received some sort of dividend payment here, right? And then its value reduced to 97.5. Okay. So we invested in month 1, 6th month, we received dividend, and then at the end of the year, we are trying to value it on our balance sheet. So if we had classified this bond as hold to maturity, on the balance sheet, we would put that value as $100 because that's our cost. Even though the fair value in the market is 97.5, but on my balance sheet, I will show it as 100 only because I have to put it on cost basis. In the P&L, I will not show any gains or losses, right? So, so no profit and loss recognized in the income statement because of this investment, even if the fair value of the asset or the bond today is 97.5. But what I will show in the P&L is that I have received a dividends of $2, right? So that's so any dividends or interest or realized gains or loss, remember this is realized gains or loss will show up on the P&L. On the balance sheet, the value will stay as it is, $100, because we've classified this as held to maturity. Now, if we had classified this bond as available for sale, then on the balance sheet, we have to record this at the fair value, which is 97.5 on the date of writing this balance sheet, $97.5. And because it is 97.5, then in the other comprehensive income, which is apart from the P&L. So this other comprehensive is beyond the P&L. I'll come to that. In the other comprehensive income, we have to show a loss of minus 2.5. and the dividends received will be part of the income statement. So as you can see clearly, there are three statements that we are trying to understand what will be the implication of the same instrument when we have classified it as held to maturity, available for sale, and trading, and what will be the numbers that we'll have to show in our balance sheet, in the other comprehensive income, and in the P&L, right? If let's say we had classified this as trading on the books, which is in the balance sheet, we have to show 97.5. We have to book a loss of minus 2.5 in the income statement, remember, not in the other comprehensive income. And see, this is and in the income statement, we have to also show $2 ka dividend received, right? So this treatment is different depending upon how you classify. Now let's just go back to this non-current financial asset section and just look at the kind of elements that they have mentioned. For example, Amar Raja Batteries has invested in this company called Standard Battery Limited, and they are using the fair value through other comprehensive income approach to value this asset. Okay, so the reason why this might be showing up as zero is because you have 125 equity shares of 1 rupees each. So this value is just 125. So, I think in decimal, if you try and do, because numbers here are in crores, so this will look like 0.00. Then you have 25 equity shares of value 2 each. Again, a very small number shows up as 00. Right? If you have, these are 5,500 shares of 1 rupees each. Again, a very small amount. Right? So, but these are all investments which are calculated on fair value through other comprehensive income approach. Right? Now let's look at so the other incomprehensive thing that I was talking about. Where does it come? So basically, this is if you look at the P&L statement, it will come below your profit after tax. So this is your profit after tax. It will come below that. And what does this other comprehensive income include? This includes I'll tell you what's the mota funda of other comprehensive income. There are a lot of incomes. There are a lot of line items that are basically profit or loss line items, which we want to keep it separate from the P&L. The idea is to keep it separate from the P&L, because P&L, we want it to reflect the true profitability of the business. That's the idea. So any investments that you do, anything that you invest in, whatever income that you generate out of it, or whatever profit loss you generate out of that, that is not your core operating profit and loss, right? So we don't want to include this as part of the P&L, and hence what we do is we've created something called as the other comprehensive income, where we capture these things, and from here on it will directly get into the other equity of the balance sheet, right? The P&L is undisturbed because of these line items. And what are these line items? Something like foreign currency fluctuation, again, not part of operations. Pension plan fluctuations, gain and losses on derivative instruments, profit loss on investments and non-quoted equity. These are all investments, either financial assets or elements which are basically because of foreign currency fluctuation or something related to pension, which is obviously a profit or a loss, but then not part of the core operation. And hence we want to separate that. We don't want these line items to affect the profitability of the business. And hence we book that under something called as other comprehensive income. And this will definitely go into other equity through the P&L, through the net profit. It will go to other equity of the balance sheet, but it doesn't come anywhere above the PAT. It always comes below the PAT, right? So till PAT, you don't have foreign currency fluctuations. You don't have gains and losses from derivative instruments. So what we are essentially saying is that whatever unrealized gains and losses we are booking on available for sale assets, it will not figure in my P&L. That's essentially what we are trying to do. But something that we booked for trading, an asset that we invested in for trading, that will figure in my P&L, right? And this is realized. Any dividends that we received, so if you look at in all of these situations, whatever dividend that we are receiving, we are recognizing that on the P&L. But because just let me tell you an example. So let's say you are invested in Zomato, and Zomato goes from 3 billion valuation to 6 billion valuation, right? You don't want this the change, which is 3 billion, to come on your P&L, right? Because this will completely affect the profitability of the business, and it will not be a true reflection. This is a investment profit. We do want to show it in our balance sheet, because on our balance sheet we want to show that Zomato is now valued at 6 billion, but we don't want to show it in the P&L. So what we do, we have created something called as other comprehensive income, which comes after the P&L, and it is added. Whatever PAT that we get from the P&L, other comprehensive income is added to that, and then that number goes into other equity on the balance sheet. That's how we've sort of kept it separate. This is just an attempt to make sure that we are not interfering with the true profitability of the business, right? Because these valuations, valuing Zomato at 3 billion or 6 billion in the private equity market, no, this is not really, five people come together and values five, private equity investors come together and value it at 6 billion. This is not really the market value, which is why you see, some assets, they grow from, you've seen with a lot of startups recently, their valuation was 1 billion, then it went to 5 billion, then it came down to 3 billion. So what is this? This is just happening between a group of investors, and that shouldn't affect our P&L. And hence we put it in the other comprehensive income, something like this, and we take it to the balance sheet. We don't bring it in the P&L. That's essentially the point. I hope you understood, the fact that, your financial assets can be categorized into different buckets depending upon your intention to either trade in these assets or hold these assets for the long term. And subsequently, they will have different accounting procedures for that, as to how much you can show it on the balance sheet, how much you can book it as part of your P&L, and how much you can book it as part of your other comprehensive income, right? That's the essence of the financial assets. We'll look at the non current financial assets when we get to that section. Now we have something called as other non-current assets. Here we have items like capital advances to related parties, prepaid expenses, balance with government authorities, and other deposits. Basically, what it means is that you've given some money to your companies, your employees, your suppliers, your vendors. That money, they owe it to you, so it's an asset for you, right? Or you've done some prepaid expenses. So, for example, you basically leased a building. So let's say you leased a building, and then for leasing this building, you gave some sort of security deposit. Now it's a long-term asset because you leased it for 5 years. So and let's say you give whatever 20 lakhs as security deposit. So this is your money lying with the owner of the building. He has to return it back to you after 5 years. So it's an asset for you, right? So basically, these are not big amounts. These are small monies given to employees, suppliers, vendors, even the money that you give to utility. So the government will say that, what, you want a different electricity line to come to our manufacturing, please submit 20 lakhs as deposit for us to supply electricity or to your workshop or manufacturing line or whatever. So, basic stuff required to run the business. We also have current assets, which have a lifetime of less than 365 days. Yeah. This again, almost the same line items we can discuss in the current section of the asset side. So with that, we've looked at the non-current assets. Just to recap, we have uh, you know so just to recap, we have fixed assets, tangible and intangible. We have financial assets, and then we have other current assets, other non-current assets. Sorry. Um, so mota that's it. You have right of use assets also as part of fixed assets only mostly. Then we have capital work in progress, anything under development, and then similarly for intangibles, you have intangible assets under development, right? So that's the non-current portion of the balance sheet. Now let's look at the current portion of the balance sheet. So current portion, some items you will find different. For example, inventory, trade receivables. Uh, this this is something that can easily be converted to cash, and the company sees a situation of consuming these assets within 365 days. Right? That's essentially the criteria for classifying an asset as a current asset. And most of these assets are used for the day-to-day operations and ongoing expenses. So inventory, trade receivables, short-term investments, cash and cash equivalents, other financial assets. This is how you would classify your non-current assets. Uh, Inventories, financial assets that have life of less than 365 days. Okay. Then your cash, which is a liquid uh, asset, other bank balances, your other financial assets, which have less than 365 days to maturity, and then other current assets. Okay, inventories, as you would know, very simple. So if I'm running a manufacturing business, I need to buy raw materials. I will have some work in progress items. I will have finished goods. All of this is part of inventory, right? So So raw materials, work in progress items, finished goods, stock in trade, stocks and spares, loose tools, all of these are part of inventory. Yeah. Um, we have discussed this in the P&L also, the matching principle, where something that was manufactured, let's say in Q1 and sold in Q2. So you manufactured in Q1, but you sold it in Q2. So this expense has to figure out in Q2, not in Q1, right? Uh, so so that matching principle is always followed. The lesser your inventory, more efficient is the business. Uh, then we have trade receivables. So trade receivables is an asset because we've sold something to somebody and they have to pay us money, right? So we've sold this to our customers, our clients, our dealers, whoever it is, they owe us money. So that's a receivable, and the receivables has to be as low as possible, which means I have to be very efficient in collecting my money as a business. Okay, so typically this number has to be as low as possible. You will see that a lot of businesses who deal with the government, especially, their receivables are very high, right? So the government takes a lot of time to pay them money. In these cases, sometimes you have to borrow a lot of money, so your working capital goes up because your clients are not paying you up on time. So you have to take a lot of short-term loan to cover up for those cash shortage. So typically, you would want trade receivables to be as less as possible. This basically means the money that company is expected to receive from its distributors, customers, other related parties. And as you can see, there is a line item called allowance for doubtful receivables. So, whenever there is a conflict with the client, he says, I'm not liable to pay you so much. You say you are liable to pay me so much. Whatever be the case, there is some amount that is not payable that the company is not receiving from its clients. That is a problem. And sometimes what happens is that they recognize this doubtful receivable as write-off in the P&L. So as you know, even for example, banks, it is very relevant. when they owe you money but they don't pay you the money, then what do? After a period of time, you write off that money, as you declare that as an NP account, and then you write off that money in the P&L. So it's a loss. Essentially, that money you had to receive, but you didn't receive. After a point of time, you just give up and you book a loss in the P&L, which is why the aging schedule is very important, because then you know how efficient the company is in collecting its receivables. Majority of the money has to be collected within 6 months. Anything beyond 6 months has to be a very small number. If a company has a lot of receivables after even more than 3 years, then assume that this is not coming. It has to be basically realized as a loss in the P&L. Right? So that's receivables. Then we have investments, current investments. We discussed non-current. In the current, you will see something called as fair value through P&L. So here, whatever profit that you are booking, that you are getting, goes through the P&L statement. Unlike the non-current, where we were doing fair value through other comprehensive income, it was not coming in the P&L. But here, this will come in the P&L. Now look at these investments. These are investments in mutual funds. There is market value available for these investments, and these are done with the intention of trading. Just look at this value in zero in 2021 and look at the value in zero in 2022. Look at the total amount. This reduced from 273 to 34.73, right? Which means we sold a lot of mutual funds, which means they were invested with the point of view of trading, that we will exit within a year. That's what they did. And hence, this will be recognized in the P&L, through the P&L. And these are current investments. So anything that you invest in mutual funds, you invest in equities with the intention of selling those equities, all of that will, the accounting treatment will be fair value through P&L. Okay. So that's your treatment of current investments. Now you have a lot of cash balances, cash and cash equivalents, other bank balances on the balance sheet, which are again liquid assets. So these are really your liquid assets. These are assets that are either already liquid or can be converted into liquid within 3 months. That's how you define it, right? Fewer than 3 months, ideally, from the acquisition date. So that's the definition. Basically, this tells you the more the cash you have, the more flexibility you have in managing your working capital. You also don't want to have a lot of cash and cash equivalent, money in the form of cash and cash equivalent. It is better to sort of invest that money in instruments that give you some sort of dividend or interest. You don't want a lot of cash just lying in the balance sheet without earning any money on it, right? Companies which have a very strong balance sheet have a lot of liquid assets, or assets that can be easily converted into liquid. So their investments plus cash equivalents will typically be very high. Look at, highly cash generating businesses, for example, smoking businesses, they will be very high on cash. Their working capital is also negative. Something like, for a business like Delta Corp, casino business, again, very cash high business. These are, that tells you the nature of the business. That tells you how strong the balance sheet is. Ultimately, at the end of the day, we as analysts have to determine the strength of the balance sheet. The strength of the balance sheet will come from your assets, will come from your how much liquidity do you hold, what is the sort of flexibility that you have. The more cash you have, the less loan you have to take. So that tells the quality of the balance sheet that you have in terms of your business. Businesses that have negative working capital, their balance sheets are even stronger, which means that you are actually collecting money from your clients even before you are delivering the service, right? So that's a very good position to be in as a business, versus a position where you've delivered the service to the client, but the client has not paid you for 6 months now, in which case your trade receivables are very high and you have to take more and more loans from the bank just to fund your working capital, right? So all of this insight you get from the balance sheet. Plus, it also tells you how much capital work in progress, how much expansion is happening. Yeah, uh, that sort of thing will tell you where the company is going in terms of the next 4 years, 5 years. How will the new revenue generation happen? Uh, the other thing that will also tell you, we'll look at these ratios, but something like a fixed asset turnover. This is an important ratio, right? This tells you how efficiently you are able to sweat your assets. So, for example, two companies in the same space, let's say two paint manufacturing companies, one is able to generate a fixed asset turnover of 5, the other is able to generate a fixed asset turnover of 3. That tells you the efficiency of these two businesses. So there are ratios that we will look into. That's a different video altogether, because that will be a longer discussion. But then with the balance sheet, for example, very important ratios that I'll just mention here, something like debt to equity. This will tell you how your debt and equity are, how your capital structure is. Uh, Less debt, more equity is the more desirable thing. Then cash and cash equivalents as a percentage of your market cap, for example. It tells you what is the strength of your valuation. Let's say you are investing, there are situations like this. Total market cap of the business is 3,000 crores and you have 600 crores on the balance sheet, right? That's a very good position to be in, uh, because you are just reasonable, very good placed in terms of the cash position. In most likely situations, this is a good value investment. Now let's look at the other current assets on the balance sheet, which is essentially the second portion of uh, other assets, the current portion of the other assets. Here we are looking at stuff like uh, you know money that you will get back within 365 days. You give advances to employees, you give advances to your clients, customers, uh, to government, some sort of tax payment that you did ahead of time, some expenses that you paid ahead of time, right? But you will get it back within 365 days. All of these are current assets. Um, you know, Mostly operational stuff here. The amount won't be that high, right? But yeah, mostly these are operational bits relating to suppliers, loans to customers, loans to employees, advance tax that you paid. Just to recap, inventory is one of the biggest items. Receivables, trade receivables uh, is the other important item here. Then we are looking at current investment, financial assets, investments done less than 365 days. Um, Basically investments which are of the trading nature, these come here and these are booked through the P&L. And then we have other uh, current assets, basically operational stuff, advance to suppliers, loans to customers, advance tax, stuff like that. Right. Now, now that we've discussed the P&L and the balance sheet, I think it's very important to look both of these statements together, because there's a lot of flow of numbers from one statement to the other. So let's just look at how it affects, how something that happens in the business affects the P&L and simultaneously affects the balance sheet as well. So for example, you are doing a revenue sale. So let's say you did a revenue. That revenue uh, came from some operational expenditure. Let's say you ran some promotions. So when you incur expenses like promotion and stuff like that, that leads to reduction in cash balance. So right. So just look at how this is affecting the P&L and the balance sheet. Okay. And the balance sheet, we have assets, we have liabilities. So if I am booking revenue here, this revenue is coming from X. after incurring expenses. Expenses can be many types. Let's just say one expense is promotional expense. That promotional expense, you are reducing cash, right? Because you're paying your vendor to do ads, and that's how you're booking revenue. And if the sales is on credit, then you have receivables also, because your customer didn't pay you on time. So there's a receivable. He'll pay you after 30 days, 45 days, 60 days, whatever. So the revenue item on the P&L has impact on the balance sheet in terms of cash going down for incurring expenses relating to getting that revenue. Plus, on the asset side, you will have receivables. If the sale is on credit, right? So your receivables will go up. Once the receivable comes down, the cash will go up, right? So that's how sales and revenue has impact on receivables and cash balance. Now let's look at operating expenses. So operating expenses, you see, you will buy raw material, for example. So your inventory will go up. If let's say you bought this inventory on credit, you are yet to pay the money. So your payable will go up, which means on the balance sheet, the liabilities accounts payable will go up, right? On the asset side, the inventory section will go up. And in the P&L, you will income operating expenses, right? Raw material expense, all that. Next, let's look at depreciation amortization. So when you buy, let's say, tangible assets, your fixed assets on the balance sheet goes up, right? Correspondingly, your depreciation in the P&L also goes up, because you've bought assets. Those assets need to be depreciated. So in the P&L, your depreciation value will go up. And the cash element will go down because you used cash to buy these financial assets, right? So that's how buying assets will affect your P&L and balance sheet. Depreciation will go up, asset side of the balance sheet, fixed assets will go up, cash will come down. Yeah. Let's look at other income. So other income, is connected to investments, because when you do investments in financial assets, right? Either you will do fair value through other comprehensive income, or fair value through P&L, and then you will also receive dividend or interest, which obviously is part of the P&L, right? So investments that you do, you will there will be a change in the value of investments, which will either capture through OCI or the P&L. Plus, there will also be dividend or interest received, which will also be captured in the other income part of the P&L. So that's how these two elements are related. Next is very simple. If you increase debt, your interest payment in the P&L will go up, right? As simple as that. If you're making more profit in your P&L, then this money directly goes to your shareholders' equity. And within shareholders' equity, it is part of retained earnings, right? So more the profit that you book, the higher is your shareholders' equity, right? So that's how these two statements are interlinked. You should now start to go through a lot of P&L and balance sheets and assess the situation of the company and where it is going, right? From a balance sheet point of view, you are now in a much better position to start reading balance sheets, go through the asset section of the balance sheet, go to the liability section of the balance sheet, look at the type of assets that you own, look at your kind of liabilities that you have, right? And that will tell you the strength of the business. First of all, it will tell you what is the current existing strength of the business. Second, it will tell you what is happening on the capex side, which means how is your revenue growth going to look like in the next 2 years, 3 years, right? This is where it will start to show up. Majority of the cases, mostly for manufacturing businesses, that is definitely the case. Then, for example, for a software business, you will have something like deferred revenue. That will tell you how much revenue is short going to come to the company, right? Uh, because this is business that is already booked. You just have to service the client and book the revenue in the P&L, right? So then you have the cash and cash equivalents, which will tell you the current liquidity of the company. Then you have the working capital in terms of receivables, in terms of payables, which will tell you how much money is getting locked in working capital. Ideally, you want to be in a business which has negative working capital and avoid businesses which have a lot of money trapped in your working capital, just in the form of inventory, receivables, and payables, right? This an efficient company will have less and less of assets trapped in the working capital, right? Right. So that's the more quickly you can turn around, uh, you know, in terms of uh, getting your receivables, doing your payables. The more quickly you can rotate the cash, the more efficient business you are. The more your money is lying around in the form of inventory, receivables, payables, the less efficient you are, right? So with all this information, you should now be able to very comfortably start to read your P&L and balance sheet. And I suggest that you do it for different kinds of businesses. You do it for example, you do it for manufacturing businesses, right? You do it for software businesses. The balance sheets will look slightly different in each of these cases. You should do it for asset light businesses like IT companies. Their balance sheet will look slightly different, right? So try and read all sorts of balance sheets. You will start to appreciate the uh, qualities of each of these businesses. Now, let me just, for example, talk about a company business called LT Foods. Right? This is a business of selling basmati rice. Now, the rice has to be aged, right? So obviously, you have inventory which is anywhere from 18 to 24 months because you are aging the rice. So all that is lying in the form of inventory. Now that's a very different balance sheet from every other business out there, right? So try and appreciate these uh, qualities of the business. Look at the type of liabilities that they have. Look at the working capital situation. Uh, you know, Something like a BST Industries or ITC on the smoking side is actually able to collect the money upfront, um, right? So their working capital is much better. They are always in the cash versus a company which is mostly uh, doing business with government. They are not getting their receivables. In turn, they are booking loss in the P&L in the form of doubtful receivables. Yeah. So on the balance sheet, it shows that a lot of the money is yet to be received even after 3 years. Ideally, that money is not going to come back to you. So that this is something that you need to understand. You don't want surprises in the P&L in the balance sheet that some company, because it was not able to collect its receivables and hence it had to show a huge write-off in the P&L, and that significantly affected the profitability of the company. Try and avoid companies which are generally very high on inventory. I mean, when you are investing, for example, in companies which are related to apparel, something like Aditya Birla Fashion, Indian Terrain, just try and understand the inventory situation of these companies, right? So all these businesses with their unique characteristics, for them, some line items will be more relevant, some items won't be that relevant. And there are businesses come in all flavors. You will start to appreciate these flavors once you start looking at the balance sheet in a more deeper way and appreciate the impact that these line items will have on the P&L. That's very important, right? Because all of these three statements are interlinked. There is nothing that has is happening in the standalone, right? Either something happening in the balance sheet will have a cash flow repercussion or a P&L repercussion, or one way or the other, everything is affecting. So conceptually, have that understanding as to how one thing will affect the other, right? With that, let me just end the session. We've completed the balance sheet. Any questions you have, please reach out to me directly. I'm always eager and awaiting to understand your questions and answer them and help you in this process. But please try and make this effort of going through different balance sheets. Look at all kinds of businesses that you can find. Just go through their P&L balance sheet and look at the value of these numbers in context to the size of the business, of course, right? So when you're talking about inventory, when we're talking about payables, when you're talking about debt, you have to look at this in terms of the context of these numbers. In one video, in the next video, after we've covered the cash flow statement, we'll look at the ratios, just the ratios, all kinds of ratios, P&L ratios, balance sheet ratios, cash flow ratios, which will tell you more about the business. And hence, and once you start looking at these ratios, you will be able to compare the operational efficiency. You will be able to compare one business versus the other business and say that this business looks operationally more efficient than the other business, right? So with that, let me just end this session. Any questions, reach out to me directly.